Hello, everyone. Thank you for being with us today. We have a really timely and important event here hosted by CCS Fundraising in partnership with the Indiana University Lilly Family School of Philanthropy. We are just super thrilled at the turnout. We've got literally a few thousand people on the call today, which is very refreshing at the interest of what we'll be talking about today. We've got some unbelievable speakers that really represent a cross-section of academia, finance, consulting, and philanthropy. So I hope that this will help you, really all of us, think about how we think about philanthropy and how it relates to what's going on in the world right now and what's going on in the economy, and how we think about running our individual philanthropic lives and the organizations that we all run that support philanthropy. My name is Jeff Erdman. I'm thrilled to be your host today. I've spent the last 40 years in the high net worth wealth management business, taking care of about 250 families. These are families that are mostly led by CEOs and founders and presidents of public and private companies. So these are incredibly interesting people who are not only focused on managing their wealth, but they're very focusing on sharing their wealth and philanthropy. And so my perspective as a moderator today is I have a front seat at some of the great philanthropists in this country and how they think about philanthropy and how they think about their legacy and their next generation. And so the other hat I wear is my wife and I are both extremely involved in our own philanthropic endeavors and organizations that we run in that department. So I'm here to learn today too, and super excited to be here. We've got a great panel of people, and I'm going to start out with two folks to spend a few minutes and give us their perspectives. First is Dr. Anna Pruitt. Dr. Pruitt's going to give us her thoughts and outlook for 2024 and 25, how it relates to philanthropy. She is the Associate Director of Research at the Indiana University Lilly School of Philanthropy. She's also the Managing Editor of Giving USA. So she's got a heck of a lot of information that she can share with us and thoughts. So Dr. Pruitt, we're going to turn it over to you, and we'd love to hear what you have to tell us.
Thank you so much. I am delighted to be here today, and I'm going to be sharing our findings from the Philanthropy Outlook 2024 and 2025. We're going to dive right in. The key research questions for this report are really twofold. First of all, what are the projected 2024 and 2025 real growth rates for total giving, as well as for all four sources of giving, including households, foundations, estates, and corporations? And then the second part is, what are the economic variables that will actually shape giving in each of these areas? And of course, we also want to note that, like any project that uses modeling, there are going to be some limitations, primarily basically changes to the variables that are used in the models might have the potential to change the outlook for giving. And of course, no model can account for unforeseeable future events, for instance, a pandemic, and certain things like that, which is just something we always like to acknowledge. Now, in terms of our top line finding, total giving is projected to grow 4.2% in 2024 and another 3.9% in 2025. The factors that will most significantly influence total giving are average growth in personal income and above average growth in the previous year's S&P 500, one of those lagged indicators, as well as growth in net worth. It can be helpful to actually see how this growth compares historically. And what we see on this slide is the average rates of change for total giving in 10-year periods. That top bar, which is in a slightly different color than the rest of the bars, represents the most recent decade from 2016 to 2025. And what we see here is that growth is projected to be 1.8% for this decade, which puts it on track to actually outpace the growth rate of the previous decade. Next, we see giving by households, which includes both itemizing and non-itemizing households, is expected to grow 2.6% in 2024, followed by an additional 3.4% in 2025. It's important to remember that households still represent the lion's share of total giving, and the factors that are going to impact giving in this segment are average growth in personal income and net worth, as well as above average growth in consumer sentiment. Now, giving by foundations is projected to have the strongest growth in 2024 at 10.3%, followed by 5.3% growth in 2025. It's important to remember here that foundations tend to make grants based on a 3-year rolling average of asset value. So we see a little extra emphasis on the performance of economic variables from the preceding years. In 2024 and 2025, we are expecting that growth in GDP and S&P 500 from the preceding years are expected to influence giving by foundations, as well as above average growth in the current year S&P 500. Next up, we have giving by estates, which is expected to grow 2.7% in 2024 and 5.5% in 2025. I do want to note here that estates are the most unpredictable segment of giving, and in part this can be because estates can be swayed very dramatically by just having 1 to 2 extraordinarily large bequests, and there's just simply no way for us to predict when those gifts that can come in. In general, though, estates go up as net worth increases, and that is, in fact, exactly what we see in this year's Philanthropy Outlook. The most dominant factor in this segment is, in fact, that above average growth in net worth in the preceding years. Finally, we project giving by corporations to grow at 1.9% in 2024 and 2.6% in 2025. The specific factors that are expected to influence giving by corporations in particular are growth in GDP and growth in the S&P 500. Now, when it's very promising to see all of this growth pretty much across the board for both 2024 and 2025, but again, it can be very helpful to see how this growth compares to the historical context, and that's really what we see on this particular slide. And what we see, even when we put all this growth of the 2024 and 2025 compared to our 10-year, 25-year, and 40-year average, is that growth is expected to actually meet or exceed the 25 to 40-year annualized average rates of growth for all sources of giving except corporations and total giving. So we really do expect this widespread growth to be a little bit above average. And giving by households and giving by foundations are also projected to exceed the 10-year annualized average growth rates. So not only are households and foundations growing a little bit better than the 25 and 40-year, but even the short term as well. Now, it's also worth acknowledging that there are some important factors to consider, and we really dig into these factors in the full report, which is why we recommend that you check it out. But 3 factors we might consider are, first of all, that right now the US economy appears to be on track for a soft landing. What we mean by that is essentially achieving a decline in the inflation rates of the last few years without tipping the economy into a recession. With that said, the environment is complex. Even the Congressional Budget Office has released a statement saying that we are in an unusually complex period and that things can shift. So it's important to keep an eye on what's happening. Additionally, we want to acknowledge that one size may not fit all. So organizations of different sizes or even within different categories might experience different results. Perhaps you had a year as an organization where you had an especially good year. That may mean that your outlook for giving looks a bit different. And we also see this same effect on the sources side. So different households might have disparate experiences within the current economic growth. Although we know that net worth and income have been growing over the past few years, we also know that there are gaps that persist among different demographic groups, and it's important to acknowledge that. Finally, the elections in 2024 have the potential to result in new policies at the state and federal level. In 2025, I think a lot of us are already starting to think about the changes ushered in by the Tax Cuts and Jobs Act, many of which will expire in December of 2025. So we will be keeping our eye out for all of those potential changes. In general, I hope these reports and these findings serve as a starting point for many fruitful discussions in your organizations and, in general, a reminder of the importance of data as you consider your strategy in the coming year. As a reminder, my colleague John Bergdahl and I will be in the questions ready to answer, or in the Q&A ready to answer any questions that you may have about this data. And I will go ahead and turn it back over.
Great. Thank you, Dr. Pruitt. Really, actually refreshing numbers to see and extremely helpful data. I'd like to turn over to sort of think about how a lot of this data relates to the economy. And Chris Heisey, who is, again, the Chief Operating Investment Officer at Bank of America, and he and I work very, very closely together. And he has a huge team of analysts and strategists who are focused on markets, financial data, statistics, and he spends his days consulting large institutions and wealthy families and helping them formulate an investment plan and make financial decisions around what's happening in the world. So, Chris, let's turn it over to you and get some of your thoughts.
Absolutely, and thank you, Jeff. Thanks everybody for joining and following on the great insights from Dr. Pruitt. We'll try to follow on that and keep that momentum going. Just general, heading into 2022, at the tail end of 21, which was a powerful move in the markets in 20 and 21, much of which was surprising early on, but then obviously gathering momentum as financial conditions became very, very easy. And we started to emerge from what we called rolling recessions, particularly in manufacturing and the goods sector. The services sector opened up, it balanced out the difficult times that the goods and manufacturing sector were having. And then China opens up. Europe did not go into a recession like everybody expected. And we started to pick up, and as Dr. Pruitt said before, the prevailing wisdom of Wall Street said that a soft landing was in the cards, and here we are. And when we wrote the report heading into 22, we talked about this concept called when oceans collide. And it was our way of basically saying, when you get two massive forces colliding together, you get prevailing cross currents. And sometimes those cross currents can actually go to the left in terms of the negative backdrop for the economy. And sometimes there's more powerful forces that move on and create momentum or waves. And that's what we're going through right now. Those two forces, frankly, one was what we all experienced after the global financial crisis. Very, very simply, we had below trend growth. So think 1% real growth if we were lucky, 1 to 1.5% inflation. So collectively, we had nominal growth of 2.5% for a majority of that period. We had 0% interest rate policy. And every single time financial conditions tightened, the economy teetered on a possible recession. That was a backdrop that ultimately led to very narrow leadership in the S&P 500, i.e. technology stocks, communication stocks, the US outperforming the world, the dollar being very strong, and the yield curve being in the basement. That's a very difficult environment from an economic standpoint, but it actually led to wealth creation coming out of the global financial crisis. The problem with that particular period is that the hole that was built during the credit crisis, that wealth creation was on top of a hole, and that just created a flat ground. So wealth creation was coming from a very low point up to what we saw all the way through 2018. And then heading into the pandemic and coming out, what we've experienced since January 1st, 2020 has been about 39 trillion in wealth creation between real estate and financial assets collectively on a base of about 118 or so. So upwards of 150 to 155 trillion in total global wealth that occurred, much of which was in the United States. So we've had significant wealth creation. That's one of the larger reasons why the soft landing is occurring, of which we would have normally gone into a recession if you consider previous cycles. Another reason that we expect soft landing, frankly, is the fact that you've got a combination of wealth creation mixed with still relatively solid job creation. Immigration starting to come through, and we could talk about that at another time, but that's leading to more spending from where some of the income cohorts are pulling back. The collective total absolute dollars of income coming in, we see it in our own bank data. We see it in our deposit accounts. We see it in our W-2s. We see it in our transaction-based accounts, our credit card data, et cetera. And we're right around that 2 to 3% consumer spending clip. on top of what still is very sticky excess savings. And then you add to that an environment where many people haven't seen in many years, which is a cash rate, which is 5 to 5.5%, which, so if you have excess savings, you have wealth creation, and you're getting at 5.25% cash rate, you're getting cash on cash. That ultimately lends itself to a much longer period where you get decent growth. And that's what we're seeing. It's taking a little bit longer than most people want for inflation to come all the way down to the Federal Reserve's target of 2%. But I would caution everybody to say that it's only been 2 years, about 18 months since it was 9%. And now we're averaging around 3. So actually, we've come a long way very quickly. And ultimately, the Federal Reserve wants to break that inflation backdrop all the way down to 2%. They will eventually get there, and we will eventually see Federal Reserve cuts, most likely starting in June, could be July, a little bit delayed, but it's really not the magnitude or the timing of the rate cuts. It's the reason behind the rate cuts. And this time around, our view is that it is to normalize the real rate. So the next regime we're going to go into is all about demographics mixed with what we call back to the 1990s. Dr. Pruitt talked about giving and philanthropy and the growth thereof in the 1990s. I think it was starting in 95 and moving forward. We're going back to that again in the overall backdrop of the economy, the overall backdrop of the markets, where you get an upward sloping yield curve eventually. By the time 2025 ends, we should see an upward sloping yield curve. So think something like 3.5 to 3.75% Fed funds, and then a 4.5 to 4.75% 10-year yield. What does that do? That establishes new rules, that establishes a little bit higher sales growth, and ultimately with the ability for corporations to maintain their margins through the use of productivity enhancing tools. So think generative AI, that lends itself to higher profitability than what most of Wall Street is already discussing. So we're a little bit more bullish than most people. We recognize the realism out there that we're continuously normalizing. But as we get through 24 and into 25 and the out years, demographics begin to take over. You've got about 130 million millennials in Gen Z, which by default are going to subsidize Gen X, which is receiving wealth creation from the overall boomers. So you get wealth creation passing on down to Gen X, a little bit better retirement plight than what everyone is talking about. And then you get the subsidization of growth in the out years by Gen Y and Gen Z. That's a tonic we haven't had in many, many, many decades. So you get the economy going back to the 1990s when the internet was first created. You get a technology stack led by generative AI to hit at the high cost areas. And then you get a little bit better margin expansion or margin containment by corporate America because of productivity enhancing tools. And overall, you get a labor force participation that goes up, upward sloping yield curve, and then demographics beginning to take over. So overall, we believe the next decade, starting around mid-24, when those oceans collide, ultimately start to dissipate and create a new regime, you get into what we call the decade or the golden decade of wealth creation. And that should beget a little bit better growth rates in overall giving from our standpoint. So with that as the backdrop, Jeff, we'll turn it back to you.
Great. Thanks, Chris. You know, it's so refreshing to hear. If when I turn the news on at 6 o'clock at night, I want to hide under my desk, and with all that's happening around the world from a geopolitical standpoint, and with elections and all that's in our face every day throughout the day. But as investors and long-term thinkers, whether it be around philanthropy or anything else, we've got to look down the road past a few weeks, a few months, a few quarters, a couple of years. And you lay out a great case for we are in a period here where people should be inspired to give and inspired to be able to save. Let's turn to our panelists now. This was Dr. Pruitt. That was extraordinary, and Chris, to get us going here. First, I want to introduce someone you're all very familiar with, Rick Happy, who is chairman of CCS Fundraising since 1998. Rick has led the firm's work throughout Western United States and Canada, and he has established himself as a philanthropic leader in the United States and abroad. And on a personal level, I will tell you that when I have a big picture to ask on philanthropy and how people are thinking, I know I'm going to always get a really thoughtful response that's filled with good data. I also want to introduce Dr. Michael Lomax. Dr. Lomax serves as president and CEO of the United Negro College Fund, the nation's largest private provider of scholarships and other educational support to African American students. Under his leadership, UNCF has raised more than $3 trillion and has helped more than 110,000 students earn college degrees and launch careers. Extraordinary background. And then I'd also like to introduce Sarah Kraislin. Sarah is the managing director and executive in charge of CCS's fundraising in the Boston office. She oversees client partnerships in the firm's operations in New England. Her knowledge of the national philanthropic landscape includes direct experiences designing and managing fundraising initiatives and for clients across the country that range from $3 million to $1 billion. So we've got some pretty impressive folks here. And I thought I'd sort of break this into three categories to talk about. And first is, how do economic trends influence philanthropy? How do economic trends influence philanthropy? And Chris, I'm going to go to you for a second. As the chief investment officer for all of Bank America's, what trends in the economy do you see most impacting philanthropy, and what should nonprofit leaders be focused on?
Well, I think the number one aspect that's going to be different as we go forward over the next 10 years is this concept of the private sector being crowded out. We all talk about the negative aspects of the national debt and the wide deficit and the rising interest costs, but what we don't talk about is how that impacts other areas in a positive way. I'm not suggesting that we all should have nations that go into high debt. But you also have to look at some of the fallout of that. What that means is if the private sector gets crowded out because there's more money spent from an interest cost perspective, paying down the national debt, that means wealth creation is going to be that much more important. So how do you create wealth? That's through the corporate sector. That's through fundamentals. That's through greater profitability. That's through inclusivity as it relates to new innovations. And that's what we do best. And therefore, we're just getting going in all this. Plus, you got population growth. The U.S. is only G7 nation that has population growth. If you get population growth mixed with a little bit of productivity, that's a tonic we haven't seen, again, since the 1990s. So even though the private sector gets a little squeezed, the amount of wealth creation, given where yields are, where rates are, where the dollar is headed, and where other nations need more and more of the United States innovation machine, despite the geopolitical curve, the most important aspect of growth, productivity, demographics, lending itself to less economic volatility than what most people believe, Jeff, and that lends itself to a more transparent landscape going forward, and that, to me, is highly correlated with giving.
Great, thank you. Rick, I want to go to you. Dr. Pruitt and Chris have both mentioned indicators, the S&P index and GDP, and that will have influences over philanthropic trends in different ways. Given your decades of experience in helping nonprofits navigate changing economic landscapes, how have you seen organizations adapt their approaches in response to different fluctuations in the economy and different cycles?
Thanks, Jeff. Let me before I answer, let me just start by thanking on Sarah's behalf and behalf of our 550 colleagues at CCS. I want to thank you. I want to thank Dr. Pruitt, Dr. Lomax, and Chris for joining us on this webinar. It's been fascinating to listen to Dr. Pruitt and Chris, really detailed trends in the economy and philanthropy. What Dr. Pruitt said, Jeff, that really resonates is, over a long period of time, you see the resilience of philanthropy and you see how steady the growth is. We have lived through some difficult moments, 9/11, the Great Recession, COVID, and what we've seen our client partners do during those times is to make adjustments and to adapt to the moment. What we don't advise them to do, and what generally they don't do, is to stop fundraising or to pause fundraising, but just to make adjustments. Does the case that we are trying to raise money for, is it still resonating? Do we have to tweak it? Do we have to extend our timeline? We're thinking about a campaign. We thought it would end in June of 2020. We probably have to make an adjustment to that. Do we have to lower our goals or manage expectations? I'll give you one example. We had the great fortune to work with the Portland Art Museum in Oregon, and in the midst of a major capital campaign. And a lot of arts and cultural institutions were hit very hard during COVID. And what the museum did was make an adjustment to raise money for COVID relief for about 3 to 5 months, and then to tag back into fundraising for the campaign. They made adjustments for the timeline. They made adjustments with how they approached donors, but overall they kept moving forward, didn't pause, and stayed steady. We find that organizations that continue to raise money, they make adjustments, but we believe that philanthropy is so resilient that in response to fluctuations in the economy, just to continue what you're doing and to focus on your strategic priorities.
That's great, and I agree with that wholeheartedly. Dr. Lomax, how does United Negro College Fund consider these types of trends and projections when you're doing your planning? You guys have had such success. Love to get your thoughts on that.
Well, first of all, I want to say how delighted I'm to be here, and thank you for inflating our performance a little bit, because you used the term trillion.
I did.
Yeah, and so I want to just correct the record. Over the last 80 years of our existence, we've raised $6 billion with a B. We thought that was pretty good. A trillion or two would have been even better, but unfortunately, we missed that mark. Thank you for thinking so highly of us. We do obviously pay attention to the economy, but the reality is, and I think Rick is kind of onto something. Those of us who are out here fundraising, this is steady work. You got to keep doing it. The more effort you put into it, in two areas. One, you got to have people who are out there knocking on the doors and asking for support. So the more workers you have doing that, or volunteers you have doing that, the more likely success you're going to have. But also, you got to have a great solution, a great product, a great service, a great reason to receive support. And sometimes when those two things come together, they really can trump bad times. And I would just give as an illustration of that, and to Rick's point, 4 years ago, and it's almost like to the minute, the country was shutting down. COVID had hit. We were going virtual. And then right on the heels of that, we had demonstrations about racial justice. At UNCF, we thought that this was a period when historically Black colleges might go out of business, and where UNCF would be lucky if we could raise half the amount we raised in any year. And we were doing a good job. We were marching toward $100 million a year. We were about $80 million a year. We shut down, we went virtual, we dug deep, and at the end of 12 months, we had not raised $80 million, we'd raised $250 million. And in the last 4 years, we've raised $1.1 billion. We've gone 3x what we were before. So sometimes the crisis can actually, depending on what the charity is doing or the organization is doing, the crisis can be an impetus to donors to give. But I would say that the news that we've just heard today is real good news on the horizon. There's a lot of wealth out there, and most of the areas where we'll be knocking on the doors, they've got money to give away. The question is, are you a worthy recipient, and are you making a good case?
That's great, Dr. Lomax, and thank you. I think I got so excited by Chris's positive comments, and I assume you have a relationship with Rick and his team. So a trillion is right around the corner. So
we love Bank of America.
Let's think a little bit differently now and focus on how these themes are directly impact donors. And Sarah, you've got a lot of experience in this. How is this impacting the conversation that your nonprofit clients are having with donors when they think about political and economic landscape?
Sure. Thanks, Jeff. And, I'll start by thanking everyone on this call who's out there doing, as Dr. Lomax said, the steady work. This is hard work. And again, I think as our other panelists have mentioned, doing the steady work over a long period of time which I think is a lot harder than most of us appreciate, does pay dividends. And we see it in the trends as we think about what growth has been like over time. So, the most depressing statistic that I often share when we're giving presentations like this is even with, we've heard about the dollars up, donors down phenomenon. I think those of us in fundraising, more people still give to charity in this country than reliably cast a ballot. So let me say that again, more people give to nonprofits than go to the ballot box and select who's going to represent them. So what does that mean? That means that charitable giving is an incredibly important way that people represent their personal values, that people indicate what is important to them, what's valuable to them. And philanthropy, it's highly personal, regardless of what's happening in the economy. And I don't know about the rest of my panelists, but even, my spouse and I, who love each other very much and are aligned on a lot of things, we don't even agree 100% on our philanthropy and the things that we want to support. So at the end of the day, people still want to know, why me? How is this making an impact? And most importantly, will this make an impact on the problem that I'm interested in helping to solve? And in our business, this is often being described as another trend, this shift from giving to institutions out of loyalty, kind of that office tower to office tower philanthropy, and shifting more toward giving to causes. So some of you are probably familiar on this call with, Bridgespan several years ago did their famous Big Bettable research. And remember, in that research, they found that most people are giving 3 or 4 gifts to an institution, before they're making their big bet. And Dr. Lomax, you mentioned this, people want to make sure that you're a credible recipient. Again, regardless of what's happening in the markets, in the broader social and economic environment, does your institution align with their personal value set, a problem that they're trying to solve? And are you a credible recipient that has a history and has a plan to help solve that problem? I think that's, Jeff, what we're seeing more and more with our donors, again, regardless of the swings that people might be feeling on a day-to-day when they look at their 401k or their IRA accounts.
Great, super helpful. And Chris, maybe thinking from the donor standpoint, and I know we get such incredible data from, like you said, deposits and spending, but any thoughts of how a donor should digest all this economic information?
Yeah, I think first and foremost, I think mixing the why with the what is going to be so powerful year after year on a go-forward basis, as we all have expressed, Jeff. Whether it's media-induced reality, it doesn't matter. We are living in a world where the gray clouds are emphasized a lot more than what the brighter, sunlight is going to do. The brighter sunlight is the why behind people do what they do. And that why that Dr. Lomax talked about and Sarah talked about, mixed with an upward trending, northeastern driven over time wealth creation machine called the equity markets, mixed with a cash machine where yields are for the first time and will likely be. We're not going back to zero. A normal yield curve, 3 to 5%, is incredibly powerful. And that means 60-40 allocation, investment allocation works again. So the transparency of where we're headed is incredibly important. And if you have built up wealth creation in stock, having that stock value get revalued over time lends itself to better growth rates in giving. I'd see it myself from my own personal why, giving back to my dear alma mater and other venues just like you, Jeff. And what keeps me going is the why I'm doing it with my family, but also knowing we get through everything. And as Dr. Lomax said, it's not talked about enough. But the impetus, when you go through difficult times, that impetus to pull through, it's a bullwhip effect. And that's what you see people galvanize together. And then that's why you see this wealth creation, because there has to be a method through fiscal policy, monetary policy, corporations, shareholder activism, you name it, all galvanizing together and ultimately creates that wealth machine. So I'm very realistic about the data we're seeing. What do we see in data? Real quick, the equity culture that the boomers and Gen Xers went through. So think late 70s, coming out of that, into the 80s, Nifty 50, into the 90s when the innovation internet was built. We're now standing on top of a technology stack. That's when technology created a base. Now we have a technology stack. You mix that with an equity culture where the Gen Zs and Gen Ys are just getting going, and the supply of equity is down 50% from 10 years ago, Jeff. You get lower supply, higher demand, and that's how you go northeast in the stock market. Obviously, you got to produce earnings, and we think earnings will be fine. So yes, we're going to have bumps in the road. We always do, and it can't go up forever, and it needs to reset itself every once in a while. But generally speaking, the trend is our friend here for the next decade.
That's great. And, my perspective is talking to donors all day, every day is, we all on this call are trying to empower and inspire people to think creatively. And there is a tremendous amount of giving power in this country that has not been tapped. And so in my role, trying to inspire people and give them a path and engage their children. And again, this generational planning that families do is very, very impactful to how they think about philanthropy. But I would say that all of us as leaders in this space have a tremendous opportunity to empower donors and to show them a way to feel good about owning something. And it's not just their financial investments, it's their philanthropic investments. So Dr. Lomax, it's critical to understand how organizations like yours and how you work to address social inequities and while navigating this conversation with donors during times where the economy and political uncertainty is clearly in our crosshairs. Can you talk a little bit about strategies you use in times like this?
Well, I would say, don't ever let a good crisis go to waste. And we seem to get enough crises that, we distribute those pretty equitably out there. I just want to say one thing about, I love what Sarah said about more people donating than voting. I think in some ways that's the case because people feel like they can control the impact of their donation. They really can't control the outcome of the voting. And it's a sad state of affairs, but I do think that we have so I'm going to say there are three big oceans that are about to collide. And I think one of those other oceans that Chris raised is really people determined to make a difference somewhere. So if they have this great wealth and they have more resources, where can they put them? And I think that they're really asking hard questions. And when they say, well, I believe in this cause, but how do I know whether it's really going to be affected positively by this contribution? And so impact is really increasingly what I think this generation of donors are going to be looking for. And we're encountering much more social impact investors. They operate a little bit more like private equity companies. They go in, they look under the hood of the charitable organization. They ask, what are its results? And then they say, if I invest, what will the return be? And so this actually the sort of transfer of the way of the conversation being, this is a charitable contribution. I'm doing it because it touches my heart. It does touch my heart, but my brain says, what's the impact going to be and what's the result? So we're really asking the question always, is what we do something that will address a major concern of Americans? And are we demonstrating that if you invest in what we're asking you to do, there will be an impact? So it's the planning is much more intentional and strategic about not just the ask, but actually what the results of the gift will be.
Boy, is that well said, Dr. Lomax, and you are going to trillions. So that's I really appreciate that. Rick, let's change a little bit here as we get close to the end here. How do themes impact nonprofits? We just talked about the donors. You've got unbelievable experience with nonprofit organizations through many different elections and economic realities. To the nonprofit, what would you advise at this moment in time?
Yeah, thanks, Jeff. And I would just, parrot what Dr. Lomax just said. When we're going to hear a lot of talk, and we're already hearing it about the election that is 8 months away. You can't control the outcome of an election. You can have influence on a gift that you give to a charitable organization. But we strongly advise everybody on this call, our clients and friends, do not be distracted by the election. Do not be distracted. Even if we hit a bump in the economy, whether it's interest rates or the markets, focus on what you can control. Focus on your strategic priorities and doing the work. As Sarah said, it's really about getting in front of people. And, that was really inspiring, Dr. Lomax, when you talked about the response that you had in 2020 and how people really stepped up. And I think that's a great anecdote for everybody on this call to take in. Like, people really responded in 2020, and they responded to UNCF in a way that was unprecedented. So, our view on this is focus on your mission, on the work that you do, and how you can move the needle. Dr. Lomax used the word impact. That's a very, very important word for donors to hear. And don't allow things you can't control to distract your mission.
Well said. I have all of us here several times a day. It's different this time, or I'm going to wait. Dr. Lomax, Rick, have a plan, execute, and don't get caught up in the short term. Great advice. Sarah, you focus lots on advancing innovative fundraising strategies at CCS. Should nonprofit leaders be thinking differently about fundraising approaches, given what we've heard from each other today?
Yeah, so I'm a millennial, and a lot has been talked about when it comes to my generation. I was driving into the office today, and there was a story on NPR that called millennials the lost generation. And I'm sitting here thinking, well, I don't feel that lost. I feel like we've lived through some challenge, but what generation hasn't lived through challenge? All of us representing different generations on this panel, on this call, we've all lived through times of challenge, different financial circumstances, different macro, social, and economic crises, and good things too. And so I tend to subscribe to the belief, I think this has been a theme on this panel, that it's a lot more productive to focus not only on what you can control, like Rick said, but also you can learn more about things that are consistent over time. You can learn more from those experiences rather than expending all this energy on trying to keep up with the winds of change, the constant elections, what's happening in the markets day to day. So what are some of the things that we're thinking about that are consistent right now? First, I think we've talked a lot about this, the continued resiliency of philanthropic growth. And I think this has been mentioned a couple of times, but I will just underscore, giving from the high net worth and ultra high net worth population in this country is not even remotely keeping up with the rate of growth of their wealth. And that is going to continue. That is going to be consistent. So if you have a credible organization, a credible plan, strong leadership, there is no reason to not get out there. And I keep using Dr. Lomax's phrase, just do the consistent work, do the hard work, make the request of people to support you. And we know it works time and time again, regardless of what the crisis is. And then the second thing I would say that's really, I think, been consistent and will continue to be consistent, again, as we're thinking about how to innovate our practices, the sophistication of our field is really increasing. So what does this mean for donors? And, Rick, Dr. Lomax, we experience this all the time, right? The quality of ideas, the quality of proposals that donors are receiving is absolutely on the rise. And I think we're seeing an increase in donor sentiment. Again, they don't want to give to institutions just because it's what they've always done. They want to give to an institution, an organization that has a credible idea that can move the needle on big problems or ideas. And I think it was mentioned earlier, a lot more donors, especially in the emerging generations, they're using consultants, they're using anonymous donor collaboratives, they're using private foundations. That's a big shift for those of us who have been in this industry for a while. So I think for those of us who are out there raising money, sometimes that can feel a little discouraging, but I think it's actually really helpful to view it in an opposite way. It's not a question of if the assets are available to be given away. It's a matter of if we've taken the time to build the trust, and if we've taken the time as an organization to build the case and to build the plan, so that when we have a great idea, we have the ability to share with donors. Yes, we have also the ability to execute it. So that would be the final thing I would say. It's not very innovative, Jeff, but I think the best innovation sometimes can come out of noticing patterns.
Sarah, I think it's awesome, and I should tell you and everyone, I think I'm a millennial baby boomer, so I need to be mentored by you. And when I look at CCS and I think of Rick and yourself and the diversity of experience and age and everything, that's why you guys have had such a great impact on so many organizations. And so I've got now both of you on speed dial when I need to know what's going on philanthropically in the world. I mean that very sincerely. So thank you and thank you to all the panelists today. This has been a really, really informative session, and I know there's going to be follow-up questions. I'd love to turn it over to Rick, who is our ultimate host today, and let him wrap things up. But from my standpoint, I just want to thank everyone. I learned a ton today, so thank you.
Thanks, Jeff. I do want to echo Sarah. Thank you for everyone for participating who came to our webinar. Thanks to Dr. Lomax. Thank you to Dr. Pruitt and the Indiana University Lilly Family School of Philanthropy. Thanks to Chris Heisey, B of A, Merrill. We really appreciate everyone coming together and making this such a interesting panel. So thanks to all of you. Thank you, Sarah Crazen, my partner, and thank you to Kara and the CCS team. We hope you have a great week. Don't be distracted by things you can't control. Thanks, everybody.
Great.